You've heard me discuss options on stocks and ETFs for over a decade now. However, today I'm going to help you better understand options on futures. We'll explore in what ways they are similar, but also different, and more importantly, potentially beneficial in certain circumstances. The good news is that if you're an experienced equity options trader, options on futures have a ton of similarities, but there are a few key differences to understand. The first is that options contracts are theoretically the same regardless of the underlying asset, whether it's on a stock or a futures contract. Options on futures typically cover a wide variety of asset classes, such as equity indices, interest rates, energy, currencies, and even precious metals. And they can either be settled in the underlying futures contract or cash settled. While equity options are only for stocks, ETF options now provide you with a wide variety of asset classes as well as typically being physically settled. One major advantage to trading options on futures is the capital efficiency, which uses span margining, a risk-based model as opposed to Regulation T for equities that applies the same margin across all products. Additionally, futures typically trade in extended hours, whereas equity options trade only between 9:30 a.m. and 4 p.m. New York time. And lastly, options on futures are not subject to pattern day trading rules and can provide potential tax benefits compared to equity options. To understand the primary differences between the contracts, we have to understand the settlement process. Options on futures will provide you with the right to buy or sell the underlying futures contract, whereas the equity option is for the stock or ETF. Futures contracts can be both for American and European style, whereas the equity options are typically American style. Futures contracts have a variety of tick sizes, the minimum amount that the asset's price can fluctuate by, while equities typically trade in pennies, nickels, and dimes depending on the option's price. And lastly, contract specifications vary heavily with each futures product, whereas equity options typically have a 100 multiplier. While there are many variations across the contracts for options on futures, we will explore how the small exchange have built products that are standardized to match equity options to make the transition as easy as possible. Let's take a look at an example to better understand the differences between the two products. In this example, we will use the small exchange precious metals futures versus GLD, the popular listed ETF. The small exchange gold futures have about a 90% correlation with GLD, with each contract representing about 50 shares of GLD. If we sold two contracts of a 22-day at-the-money put on the small precious metal futures, it collects $172 of premium with a $1,027 margin requirement. This will generate a 6.74% static yield, requiring margin of about 7% of the notional value of the futures contract. Compare this to selling one contract of the 22-day at-the-money put on GLD, which collects $246 in premium with a $3,464 margin requirement. This generates a static yield of only half as much, of 7.11%, because the margin requirement is over 19% of the notional value. As you can see, the span margining of futures provides a better capital efficiency, requiring only 7% versus 20% of the notional value, which greatly increases the static yield of the strategy. Keep in mind, the capital efficiency does not change the risk of the strategy. It simply changes the cash that you are required to enter the position. This allows you to deploy the rest of the capital to other investments, such as low-cost index funds for capital appreciation or income. The capital efficiency of options on futures are most advantageous for options sellers. With more than a few decades of backtesting data, we know that options premiums consistently overstate realized volatility. And to take advantage of this statistical edge, options selling strategies such as short puts, straddles, strangles, and iron condors can be deployed more efficiently with options on futures versus the corresponding ETFs when the implied volatility is elevated relative to its own history. You can use both IV rank or IV percentile as commonly used in this industry to identify these trading opportunities. I will explore this concept further in a future video this year. At this point, I want to take a pause and introduce the small exchange, because their ethos for designing futures contracts that are small, standard, and simple provide the ideal futures products for retail traders in smaller accounts to trade this exact strategy. The biggest advantage to options on the small exchange futures contracts is the standardization. All contracts have a 100 multiplier with expirations on the third Friday, and they are all cash settled. This simply makes the transition from stock and ETF options over to futures much easier in my opinion. Additionally, compared to the traditional futures contracts, the contracts that we review today only require a few hundred to about $1,000 in margin to execute per contract. This allows for even the smallest of portfolios to implement this exact strategy, which typically was only accessible to institutional investors. With the capital efficiency, you have the flexibility to potentially invest the rest of the free capital in index funds, such as equities or bonds, for additional portfolio performance. To better implement the strategy and to find opportunities to sell premium, the small exchange offers correlation analysis of ETFs to their corresponding futures contracts with contract sizing. These data points can be utilized to make informed decisions for option selling strategies, such as the examples that we reviewed today. If you're interested in becoming a community member, I have an exclusive 50% discount for anyone who wants to purchase a lifetime membership for just $50. You'll receive a weekly newsletter with these exact calculations, 50% off all exchange fees when trading small futures contracts, and exclusive swag like t-shirts, hats, and other merch. Click on the link below to receive our exclusive OptionsPlay 50% discount on your community membership for the small exchange. If you're interested in learning more about how you can trade options on futures using this statistical strategy, please watch the full webinar that I've linked below. And to get started on trading small exchange options on futures products, you can open an account with either Tastyworks, IBKR, or several futures brokers that I will link below. And make sure that you enable futures accounts when you're opening your Tasty or IBKR account, which I will include in the instructions in the description below. I really hope that this video provides you with an overview of how options on futures can provide a potential advantage to trading the corresponding options on an ETF. And if you're considering options on futures, I hope that this video inspires you to learn more about how statistics can be used to identify trading opportunity for options sellers. And if you currently trade options on stocks or ETFs, please let me know what your experience has been transitioning to options on futures in the comment section below. I do read and respond to your comments, so keep them flowing. I'm hosting monthly education on futures trading in 2022, and I look forward to seeing you at the next event. Register using the link in the description below. And I'd just like to say a huge thank you for watching this video, and please hit subscribe and make sure you click on the notification bell to receive a notification the next time I post a video in this series. And with that, I hope that you have a great trading day.